Hey, good morning, everyone. I'm Pat Swanson, the RMA Administrator, and I'm welcoming you here today to talk about the SDRP2 program. And, as a former agent, I know how important it is for our agents to know about the programs that that affect our farmers. So I'm thrilled to have so many of you join us already this morning to hear more about the SDRP2 that's been rolling out through FSA. And I'm going to hand this over to our FSA Administrator, Bill Beam, and appreciate you all being on here, and thank you very much.
Okay, thank you, Pat, and thank you everybody for joining us this morning. I don't have a whole lot to say other than I really appreciate RMA and working with our team as we develop this program, SDRP2. It's critical that we work together, and every bit of information that you can share really makes the experience much easier, if you will, for all those farmers that are signing up for the program. So basically, I want to say thank you to everybody. I want to say thank you to my team. They put a lot of effort into this program. Yeah, we will not delay any longer. So I'm going to kick it over to Kathy Sayer, and Kathy Sayer will take it from here. So thank you.
Thank you, Bill. Good morning, everyone. I'm Kathy Sayers. I'm the Division Director for the Safety Net Division, which is under the Deputy Administrator for Farm Programs under FSA. We administer all of the disaster assistance programs in our division. And so today, you are lucky enough to hear about the new SDRP Stage 2. As you know, we had a revenue-based model under the Emergency Relief Program for both 20 and 21 and 22 that covered all of the shallow losses and losses that were not indemnified. So this time, under the Supplemental Disaster Relief Program, based on feedback that we received from a lot of producers and stakeholder groups, we've transitioned back to like a WIP Plus model, which is more of an individual crop yield production type loss model. And so we have collaborated with RMA extensively to be able to utilize the data that producers have already filed through their crop insurance agents and through FSA on the NAP side to pre-populate applications. And as we go through the presentation, you'll hear a lot more about that. Chris Vasquez, our section head for the disaster assistance section, will go into a lot more detail. I'm just going to provide an overview and talk logistics right now. So in moving from that revenue-based model to the shallow or to the individual crop basis, producers are able to apply, crop by crop and be able most likely to, if they have a shallow loss on one crop, be able to be compensated, whereas it's not holistic revenue type model. So we're hoping that this is much better. You're going to hear a lot of this program is really big, very complicated and all. It is very big because we've combined a lot of different pieces into SDRP Stage 2. Today, of course, we're going to concentrate on the insured pieces only. We'll briefly touch on what else is included, but today, with it being an RMA webinar, we are going to focus only on the insured pieces. However, the program may be really big this time, but because of the different systems that RMA has put in place for capturing production data and different things, and the collaboration between RMA and FSA, we hope that it's simplified a lot for the producers and for our county offices in utilizing that data that's already on file. And so if a producer agrees with that data, in a lot of cases, they're not going to have to do anything else unless they want to, go to apply for quality or such. And you'll hear a lot more about that today. Now, we're going to go over, a lot of information today, but at the end, we are hoping that there's going to be some time for questions and answers. We'll go over as many questions and answers as we can. You can post your questions in the Q&A and we'll address them at the very end of this meeting if we can. You're not able to come off of mute, so if you have a question, make sure you post it. This meeting will be recorded, and it will be posted on the RMA website. There's the questions that we are not able to get to today. We will meet as a group, answer those, and we will put those on the Q&A document that we continue to maintain throughout the SDRP program. If you'll remember back to stage 1, we did the same thing. Any questions that you guys have that we can't address, we'll update it publicly. And then throughout the program, we continue to add questions and answers to that document. RMA posts that, as does FSA. We will post a couple of different links to websites. One, our SDRP website on the FSA SDRP website, so you can have that. There's a lot of very helpful information on that website. And then RMA is going to post their link as well. So with that, we're going to go ahead and get started just on the overview of the Stage 2 program. As you know, the American Relief Act signed in December of 24 is what authorized this program. There was $30.78 billion in total of disaster assistance, but for the SDRP program, $16.09 billion is what has been allocated for both Stage 1 and Stage 2. If you remember back to Stage 1, when we trained, we talked about there are certain states that have decided to conduct their own crop disaster program. And they're doing that through block grants that were also authorized in that same act. And those 4 states are Connecticut, Hawaii, Maine, and Massachusetts. So if there was a record that was physically, or a farm that was physically located in any of those 4 states, those records are not downloaded to the county offices, and those producers for that specific land is not eligible to apply for SDRP because they will be getting compensated through their state crop disaster program. We are still in collaboration with those 4 states. I don't know the timing. The timing will probably be different for each of the 4 states. So if you are asked by your producer, they would need to go through their state departments of ag to determine when the timing for their sign-up is going to happen. Linkage is the same. Producers must purchase a coverage at 6,100 or higher, and that's based on coverage level and price selection. It has to equate to a 6,100 coverage. So an overview of Stage 2. Remember, these are the non-indemnified losses. So of course, Stage 1, we covered all of the indemnified losses, those that received crop insurance indemnities or NAP payments. These are the ones that did not qualify for those, so crops with shallow loss. And you'll hear a lot more of how we have divided the program up, and it's because of the data that is available based on the type of insurance coverage a producer elects to purchase, and also sometimes the type of crop. So for instance, value loss. So it's crops with shallow losses. We break it into an APH yield-based plans, and you'll see as Chris goes through it in detail, the plans of insurance that are going to be in each category. It's probably a little bit different than how you think about it, but it's based on the data available, and you'll see more about that in a bit. Then there's area plans, dollar plans, and other revenue, value loss, and then trees and vines. And then, of course, Stage 2 also includes NAP covered crops, and it's broken down into yield-based and value loss. One of the biggest changes, or not changes, but one of the biggest things for Stage 2 is that we do cover uninsured losses. So those producers that did not purchase coverage under either crop insurance or NAP are eligible to apply for Stage 2, but the coverage level, or the SDRP factor, is at a 70% SDRP factor. And those are broken down into yield-based, value loss, and then trees, bushes, and vines. The last piece is Puerto Rico. Puerto Rico, as you know, are insured differently than any other area. And so there's a separate piece for Puerto Rico insured producers. And it's broken down into indemnified, non-indemnified, and then trees, bushes, and vines. Puerto Rico producers that are NAP covered or have uninsured losses, they can apply right now. This last piece of insured Puerto Rico producers, that will be the last phase. We'll talk about that in just a little bit on time frame, but that is a difference of how we are handling Puerto Rico insured producers. Another addition to SDRP is quality losses. If you'll remember back to the WIP Plus days, we had a separate program, which was the Quality Loss Adjustment Program, QLA. And this time we've incorporated that into SDRP. So our stage 2 producers that have quality losses will be able to apply at the time of their stage 2 application. Stage 1, since we've already conducted stage 1 application process, that one is going to take just a little bit longer. We are expecting that to roll out in early January or early 2026. I'm sorry, early 2026. So, but those producers will, if they have quality losses, will be able to apply. Our sign up for stage 2 began on November the 24th, and all of our county offices have been trained. The 504 is the application form. You're going to hear this multiple times, but we do not accept manual applications. A producer will need to work with their county office to apply in the automated system. So manual applications will not be accepted. The deadlines have been established, and those are published in the federal regulation. Our application deadline will be April 30th of 2026. All of those associated eligibility forms, we have 1 year after the final application deadline. So April 30th of 2027 are the eligibility forms deadline. Now, it's in the producer's best interest to go ahead and get those in, because that could delay a payment if they don't have all of the forms in, but there is a separate deadline. You're going to hear a lot today of when records are required and when they are not. So again, different than WIP Plus, there can be, especially with the higher percentage of yield-based, APH and yield-based policies, there is a possibility in a lot of cases that producers will not be required to provide additional documentation. But stage 2 is different than stage 1. And so there are certain circumstances where additional documentation will be required if there's going to be a change or a quality application. Again, we started the sign up November 24th. Right now, the software allows for all insured, NAP covered, and uninsured crops through the application process. The only things that we're waiting for right now is our tree, bush, and vine. Our tree, bush, and vine process will come out in early December, around the 10th. And so then those producers would be able to apply for the tree, bush, and vine part. Like I just said, on stage 1 quality, we're going to roll that out at the beginning of 2026. And then that last piece of the Puerto Rico insured producers will be the very last software component, and it will be released also early 2026, but a little bit after the stage 1 quality, most likely around that February, March timeframe. We have already referred to the SDRP website. Again, we'll pop this in your Q&A chat, so you do have the website link, but there's a lot of really good information on the site. As far as resources, it has the fact sheet, the FAQs, it has a link to the federal regulation, this at-a-glance card. So when you're working with your producers and they're getting ready to go in and apply for SDRP stage 2, the at-a-glance card is like a producer checklist, and so it will help prepare them on the pieces of documentation that they may need, or at least the information that they will need to review to verify the numbers that they're certifying to. So that is the biggest tool that I would encourage you to tell your producers, make sure that they look at that to prepare themselves for that application appointment. So on our program provisions, They, of course, were published in the Federal Register in November. Even though those pieces of the software, the tree, bush, and vine, and the Puerto Rico piece are not in our automated software right now, everything was included in our Federal Register. So if you want to know about the rules of those specific pieces, they're in the Federal Register document that has already been published. You should have all of that information. Our county offices have received our one SDRP handbook in draft. Our directives division is still working on getting that formatted properly for public publication. That they're still working on that. We thought it was going to be this week. Most likely it's going to be next week. You know, the shutdown has kind of put us a little behind on the directives front, but the handbook should be published next week. So you guys could download that as well if you have any other questions. And that is it for the overview. I am now going to turn it over to Chris Vasquez, our Disaster Assistance Section Head.
Thanks, Kathy. All right, so I'm going to jump in. We're going to go over really kind of an overview of what this program is and its implications and what may be needed out of you all from your producers so they can complete this application process. So the application process, it's the FSA 504, that's the stage 2 application. It contains 15 separate parts. Now these parts are separated based on if they're covered by crop insurance, by NAP, or if they are uninsured. But the important thing to point out is that only the applicable parts of the application are going to populate. So if a producer only has one type of insurance, it's only going to populate in that applicable part. You're not going to see the other 14 parts of that application. So that will shorten it and make it quite not as burdensome on the producer to see all of that. Now, as Kathy mentioned, it's important to remember that there are no manual applications. The producers have to be in contact with the county office so that the automated form can be printed for them. We have downloaded and leveraged data from crop insurance that are already in the FSA system within NAP, or even for the uninsured that really there is no data, but we have to have our foundation. So they've got to come in and do their acreage report. And once we have that information, then the application can be generated. For that reason, if a producer was to try to do a manual application, there'd be a whole lot of parts on that application that would make no sense. Even our county offices probably couldn't help them to generate what should be in some of those areas. And I'll go through and we're going to talk about, and I'll point those out on what's pre-filled and what's not, and really where the responsibilities are for the producer. But first, before we get into the individual applications, we're going to talk about quality and how quality applies within this program. Now, when we were looking at quality, we really kind of went through and leveraged what we've done in past programs. So we looked at QLA, which was the program that was attached to WIP for losses, quality losses. I believe it was 17, 18, and 19 possibly. But that was one of the most recent, really strictly quality programs that we've done. And so that is the foundation on which we've used to build the quality losses here within SDRP for both stages. Now, stage 1, where there's going to be more to come on this later, but stage 1, that only is going to apply to insured APH or yield-based crops and NAP yield-based crops only. Now, with the thing with quality, what we're looking at is it has to be a production-based crop, so it can't be any of our inventory crops, can't be trees, bushes, and vines. And then it also, when we're looking at stage 1, can't be where quality was already accounted for through one of those crop insurance products for stage 1. So we'll get more into that. But for stage 2, those are the shallow losses, so quality was not included. It allows us to cover more of these different maybe products that, because they weren't indemnified under stage 1, we're going to pick those up here under stage 2 for the crop insurance and NAP, as well as the uninsured. And that's going to be on the same application of that 504. Now, where it's going to show up is it's going to be the insured APH and yield-based crops, or insured dollar crops and other revenue, the NAP yield-based crops, the uninsured yield-based crops, and then the insured crops in Puerto Rico. Now, where quality is not applicable is for insured under an area-based plan, crops where quality has already been compensated under stage 1 losses, any crops where production was already reduced for quality under NAP, and then going into some of those specific crops, maple sap, honey, trees, bushes, and vines, any crops that were destroyed, prevented planting crops, or value loss crops. Now, for quality loss, what we're going to take a look at is there's really 2 avenues. And one is we're looking at a total loss in value of the crop due to reduction in that physical condition at the point of sale, and then as well as a nutrient factor. So each of those will have the quality will be calculated separately. So we're going to bucket them 2 buckets: forage and all other crops other than forage. For all crops other than forage, we're going to base it on a decrease in value based on the discounts provided at the point of sale. Now, this is similar to QLA. Now, the difference between QLA and SDRP is that we are going to use a percentage of loss and take that percentage of loss and reduce the production to count. And so you'll see when we start going through these applications where the producer turns in production, and then we'll explain the calculation on how that works. But essentially what it's going to look at is producer takes quality production to the elevator. The expected price on that day was A. The received price on it was B due to quality reductions. The difference between those is a percent difference. And so in the example here, it comes up to a 5% quality loss. So for example, I don't know the math on this, but it was a $5 was expected. Received was $4.50. The difference is that percent. That's what they're going to turn in as a quality loss on their application. Now for crops, for forage crops, it's going to be a little bit different. And this is going to be based on a nutritional value. Now, under QLA, that nutritional value was established with a baseline. That baseline was established looking at 3 previous years. For this program, we will not establish the baselines, but the Farm Service Agency will establish ranges. And so we're going to categorize these forages into these different. And then for each category, we'll have its own unique set of ranges. Now, if those ranges are not really representative of what may be happening in a certain area, FSA is allowing the individual state committees to make recommendations to the FSA national office, and those can be considered for different ways to calculate the forage loss. Now, to start off, we're going to start off with using relative feed value, or TDN, but it's not going to be limited to those. So if we're looking at a certain type of forage in a certain area, it's more representative to maybe use TD RFQ, then that can be used. That's just they have to submit that documentation up, and so we'll work with our individual states on that. Now, the application process, the deployment stage 2 is deployed right now. And so that's out there. It's the great part about it is it's one way to calculate. Now, how the applications are going to look and how the stage 2 application looks compared to stage 1, it is a little bit different. But how they're going to calculate that quality loss, it's the exact same. And what it is we're going to use it's going to be weighted based on affected versus total production. And so we're going to take a look if the producer has, let's just say, 2 different loads on 2 different days, different quality losses. They're going to take a look at the total production, and then what was the quality loss that was affected, and weigh it across the total so that it comes up to 1% number. And then on stage 1, it's the same thing. It's going to be that weighted quality loss. Now the difference is that we are going to take a look at where did RMA, or through these crop insurance products, already account for a quality loss. RMA is providing that to FSA, and then what the producer will do is look at what their quality loss was. if RMA compensated, if their total quality loss was 5%, crop insurance already compensated for that 4%. RMA is providing that 4% to us. And so it's going to take the 5% minus the 4%, and it's going to calculate the quality loss on that 1% that wasn't already determined. And so and then when we point out it's on these APH and yield-based crops, and we'll get into more of this as we get and show you how these are bucketed. But the crops, the programs, the products that weren't included for quality loss are those where quality was already accounted for when they are indemnified. So remember, under stage 1, those were already indemnified. They already accounted for a quality loss. So those are not included as this additional quality percent. Now, when we go back to QLA, there were some exceptions that were built in for really the quality for the grading criteria and that documentation required. And so those were upland cotton, small grains sold as feed, pulse crops sold as feed, sugarcane, and peanuts. Now, we have the 2 calculators out there right now. Those calculators are available in that link that was put out on the FSA site, but we're also going to be building out calculators for upland cotton, sugarcane, and peanuts. Now, up first is the only 2 that we have out there right now are the all crops other than forage, and forage calculators are out there. We are in the process right now of getting the upland cotton generated. Peanuts will be next, and then sugarcane will follow. The small grains sold as feed and pulse crops, they would just use the all other crops calculator that's already available. It's just a little bit different documentation requirements. So like, as we mentioned, there's a calculator. It is out there. It's been created. And then how to access that calculator is through this website. I encourage you, if you have any questions on this, to go out there, take a look, play with the calculator, and take a look at how it works. Now let's get into the insured crops. So when we're looking at this application, it's broken down into, depending on the type of product, what part of the application it's going to fall on. So Part C is the APH and yield-based plans. Part D is where we have our insured area-based plans. Part E is the dollar plans and other revenue. Part F are the value loss, and Part G are the trees and vines. Now, how we bucket them is largely based on our calculation and the data available. So I know that when you look at these and you see like our value loss plans and the trees and vines, you really think of those as more as dollar plans. But when we look at the calculation and how we're calculating those, they're different. So what we have here bucketed as Part E for the dollar plans and other revenue, that's where we're coming through and we're actually doing a yield calculation. So the value loss are going to be your nursery plans, your clams. Those are ones where FSA calculates those based on an inventory calculation. So it's a value of an inventory immediately before and immediately after. And then the trees and vines, we have a calculation for that as well that's different. So it's really based on the tree being damaged or completely destroyed. And so there's a different calculation for that. So that's why you're seeing those bucketed a little differently than maybe how you would traditionally think of those. So the first one we're going to talk about is the insured APH yield-based plans. Now here is a list of the plans that we have bucketed into this insured APH yield-based. And the reason they were bucketed here is because it's all regarding the data that is transferred from you all through their AIPs into RMA, that RMA has available to share with FSA in how we can go through and try to calculate these programs. Now with these, the reason they're bucketed here is because the RMA can provide us the liability. So that's acres times yield times a price times that SDRP factor. That SDRP factor is dependent on the producer's coverage level. So the producer has, for instance, let's say 65 coverage. I believe the corresponding SDRP factor is 87.5. Now it's important to note that because this program, the focus is to pay on shallow losses, it's only paying on any loss that would occur between that 65%, 87.5%. If for some reason the producer's loss would fall into that first 65%, this program would not cover that because that's what would have been covered by crop insurance. And this program is only made to include or is only meant to cover the loss that occurs between those two coverage levels. And we'll get more into that as we get through that. But the other part that makes this is that there is production that in some cases that has been transferred. And this is the production that producers turned into you all, that you transferred to the AIPs for maintaining yield purposes, production, and keeping track of those records. So that is the production that is turned down. So here's what the application looks like. So numbers 11 through 18, it really looks like what you see on stage 1. We have our pre-filled information is still the same crop unit number that we're going to get a hold of what those primary policyholders are, as well as the SBIs. Where it starts to look different is the second part, so 19 through 27. But you can see 19 through 23 is pre-filled. Now 22, that's what I just talked about. That's where we're getting that liability. So that's the acres times yield times price times their coverage level. So that's their SDRP factor here, but that's what is used to count for determining their premiums. We know what that is. We're able to utilize that and lean on that. And then next is that RMA certified production. That's going to be provided to us. Now, we know in a lot of cases too that may not be representative of of a loss situation for that producer. So we have built in item 24, where its producer can certify to a different production. If they look at that number in 23 and say, well, you know what, that's not really representative. There's production that's included in that really shouldn't be for loss purposes. They can come in on number 24, certify to a production record, and then turn in acceptable records. Now, what is an acceptable record? An acceptable record is either a record that's either verifiable or non-verifiable. Verifiable is through a third-party source. We can look at that record and we can make a contact to that grain elevator. They can verify the information on there. If the producer does not have verifiable records, what they can have is a non-verifiable record. And we can look at those records and say, yes, but we can make them reliable. So that's where the FSA County Committee comes in, starts taking a look at those records and comparing them to one another to say the loss level is really on par with what we're seeing for others in this area. And so that's what they can have. Now, if there may be instances where a producer has no records, we have the ability to count for that as well. In that case, the producer can just turn in what they have. So it's essentially now we're in a non-verifiable record situation. And then the producer will get the higher of what that certification is, or we will assign production based on a county disaster yield. So each county will establish what that yield is. And then you take that yield times their acres and determine what that assignment of production would be. But the important thing is when you come back and look at 23, you may see situations where that number, if they were to use that for a calculation, it would not calculate an indemnity. So like I said, they can come back and do that. We also know that it may be blank. Producer maybe changed agents, or it may have been a situation where that information was not turned over to the AIP, so it's just not there. That's not a deal breaker. It's not a problem. There's really no action that's needed from you because the producer can turn in those records. Now, where I would anticipate that there may be questions is really that number 22 on that SDRP liability. Now, we are providing a supplemental information report. We're calling it a SIR, and that's available at our counties that they can provide to the producer to really show them what's the acres yield, what price went into, how they are calculating this liability. Now, if they have any questions on, why are the acres that number, we're going to that's when they'll say, well, work with your agent, go back to the agent to help them answer those questions. But we're trying to provide them with all the tools they have to really try to keep down the number of questions. But that is one where I could see really questions to you all. And same as like with stage 1, if there are discrepancies in those numbers, you would work with your AIPs to get that information updated. AIPs would transfer that information to RMA, and then we are going to work on have a schedule going for when we're going to process these change records, same as how we're doing stage 1. So as our scheduled time, we would process those and get them through there. But the important thing is they're going to turn in these records. Now, for the quality loss, this is number 25. That's what we talked about previously. So that's where they're going to come up with determining what that percent of that quality, what was that percent quality loss for that crop type. Now, coming into what the calculation is at its base the same for all the crops. It's just how do we determine what it is? And where it becomes the same is we have expectations and we have actual. Now, for the yield-based, our expectations are based on that liability. My actual is my production times the price. So how we're going to calculate that loss is we're going to take that liability minus production, counting for a quality loss, times the price that's used by RMA to calculate the liability. So that's important because there are some of those products that have a harvest price. We are not going to use that harvest price. The price is going to be the price that was in place to really calculate what that liability was. The next is where we have that potential insured indemnity. That's where we're taking in and calculating essentially what would that payment have been, so that we're only paying the difference between the coverage level and that SDRP factor. But you'll notice that on that potential insured, it is just the production. There is no quality loss discount applied there. So we're going to take just the production times that same price times their price election. Now that stage 2 payment, it's going to take that calculated loss from that first bullet minus the potential insured from the second bullet. If that number is greater than 0, we're going to add back in the premiums and fees. Now, when we go back to what Kathy talked about earlier, there was $16 billion that was put aside for this program for SDRP for stage 1 and stage 2. If we were back to stage 1, we applied a 35% payment factor to make sure we can get the payments out there. It's the same payment factor that's going to be applied in all of stage 2. Now, we also have it built into our regulation that after sign-up is complete here at the end of this coming April, the agency will then go back, make an evaluation to see if there are any funds remaining, and then if there's going to be the ability to increase that payment factor. Now, if FSA were to do that, there would be no action required. It would just be a change, and an additional payment would be addressed. Now, last time I believe we did that, at least on the programs that I work on, was with ERP. The phase 1, there was an additional payment that was issued there. So that is the premise. You're going to see that 35% payment factor applied. The next is the area-based plans. Now, the plans that we're capturing here are those area yield protection, area revenue, your rainfall index. So these are the ones that we are capturing here. This one's a little bit different because remember, under stage 1, the defining what made it a stage 1 application was that it was indemnified. Under stage 2, it was not indemnified for shallow losses. Now for area plans, it's going to be a little bit different. We still have the premise where we're catching anyone that wasn't indemnified. Those are being pulled over. Additionally, we are looking at, for like the annual forage, that were disapproved under stage 1 because when we looked at those, there were grazing acres that we knew the producer had. We had to differentiate those out. Since there was no way for us to tease out grazing acres within annual forage, we had to exclude those. And so under stage 1, those were disapproved. Now, the reason for that is because grazing crops are ineligible. Those are covered under the other program that we have, the ELRP. So those we cannot pay under this program. We had to pull those out. So under stage 2, what we're going to allow for is a bifurcation. The producer can split out, and I'll talk a little more about this in a minute, of essentially the percent of that payment that can be attributed to eligible crops and for ineligible. Now, when we're looking at the application, numbers 28 through 35 largely looks the same as what you've already seen. It's pre-filled. Producer just has to indicate any shares that are going between primary and SBI, the agreement to purchase crop insurance, that's the linkage agreement, and then indicate what that disaster event is. 36 is pre-filled, that's the RMA insured acres. So that's going to give us the total acres that are going to come in. And then number 38 is pre-filled that SDRP payment. Now for 37 is where it's different. This is where the producer is going to enter in a percentage of what is eligible, essentially eligible acres is what's going to come in. And I'll go through here in just a more minute how they're going to make that how they will make that percent difference. Now the calculation is going to be the same calculation for stage 1. The stage, and that is, it's going to be a recalculation of how that product indemnifies, except you're going to substitute in the SDRP factor in place of that coverage level. Now, under stage one, remember those were indemnified. Stage two, maybe you had some that didn't rise to the level of indemnification. They had a shallow loss in some of those area plans. So we're going to pull those over. What we're adding in is we're going to take that estimated SDRP payment times that producer certified percent of eligible acres, and then multiplies that times that 35% payment factor. Now, the difference here is that the producer's premiums and fees are already included in this estimated SDRP payment. Because we know that it wouldn't be sent to us if there wasn't a payment that was already calculated. So that's, or RMAs are taking care of that in that data transfer and including that over to us. So how we're handling this bifurcation of payments. So if the eligible acres on the 578 is equal to or greater than the RMA insured acres, then the producer can certify that 100% of the acreage is eligible. If the acreage on the 578 is less than the RMA insured acres, then the producer will determine the percent difference between eligible acres on the FSA 578 compared to the RMA insured acres. And so here's just one example, and this one's dealing with annual forage. So in this case, the producer reported on their FSA 578 that they had 100 acres to forage, 50 acres to grazing, and 50 acres to grain. Now, under annual, for FSA's purposes, for SDRP, those grazing acres are ineligible. Now, when we look at what was sent over on the application, the RMA insured acres is 100 acres. So we remove those 50 acres out. Producer has 100 acres to forage, 50 acres of grain, so that's 150 acres total. Since that 150 acres is greater than the 100, the producer can now certify that 100% eligible acres in that item 37 on the FSA 504. So the next up is the insured dollar plans and other revenue. So these are the plans that we have bucketed in to this section of the form. Your pecan revenue, actual revenue history, your fixed dollar amount of insurance, and these others on here. So these are ones where FSA is deviating from how these plans indemnify. These indemnify based on a revenue calculation. SDRP stage 2 is not going to do that. So the calculation is going to be, at its heart, very similar to what you saw in APH, but we're going to convert these into a production base. So the producer is going to have an acres times yield times a price and turn those in. So how we're going to determine those is really, it's limited from the information we're pulling from RMA. That acres, that's going to come from FSA. They're going to have to file an acreage report. The yield, they're going to be assigned in a yield that is 100% of the county expected yield for that crop in that county. And then the price, that's going to be the average market price that FSA has established. So that's what we're using to determine what that liability is. Now, for the SDRP factor, that's going to correlate back to how they were insured. So we're going to look at what their coverage level was and give them the respective SDRP factor. That's the left hand of the equation. The right-hand side, producer has to turn in those production records. It's the exact same rules for turning in production as they were under those APH-based plans. It's going to be the same rules. The only difference, of course, is there was no production that was submitted, so there's nothing coming over. So in all cases here, the producer has to turn in production records. But as far as the calculation goes, it really is the same thing. We're taking liability minus production that accounts for a quality loss, times our average market price, times the stage factor, times the share of the crop. For the potential insured, we're going to essentially duplicate that same calculation, account for production without a quality loss, times the price selection, times the stage factor, times the share. We're going to, if the calculated loss minus potential insured is greater than 0, we add back in those premiums and fees, and we multiply that times the 35% payment factor. Now, here's a view of what that form looks like for these areas. So you can see the pre-filled items 40 through 47. It's identical to what you've seen as other parts. 48 through 63, that's the bottom part. And so you can see where a lot of this form is still pre-filled for them. It's just, where is that data coming from? So in this one, if a producer comes to you with those questions, there's not really a whole lot you can do unless they're maybe questioning SBIs on the application that shouldn't be, or vice versa, or missing SBIs. That's where we'll need your assistance working with the AIPs to get that updated. But if a producer has a question, and we've trained our counties on this as well, question on that liability, that's really a question for FSA. So if that's in the same thing, production, producer's going to turn in those records, acceptable, same idea, and then the same rules apply on how they're going to determine what that quality loss percentage is. Next, we're going to go to the insured value loss plan. So this is really just applies to nurseries and clams. So here's the two plan codes and what the form looks like. So these are ones you can see, same information for parts 64 through 68, which is pre-filled. 69 through 72, it's no change. 73 through 83, you can see what is pre-filled and what the producer has to turn in. The difference here, of course, there's no acres, yield, or price to determine that liability. Producer is going to turn in their inventory. What was my inventory immediately before, and what was my inventory immediately after the disaster? Now, with these, because we're looking at an inventory-based approach, there could be more than one loss that occurs during the different lists. So like we're running on a year here, on the fiscal year, we had an event, maybe it was a winter storm that impacted the crop first, that would be event 1. Then maybe sometime in July, there was an excessive heat event, that would be event 2. Producer would turn in what was my inventory before and after for each of those events, and we could go through and go through and make that calculation. Now here's just a breakdown of that calculation. It's that dollar value before times that SDRP factor minus the dollar value after times an unharvested factor minus any salvage value times FSA share. Same idea, we're doing a potential insured indemnity. So we're going to take that calculated loss minus a potential insured. If that's greater than 0, we're going to add back in premiums and fees, multiply that times the 35% payment factor. And then for insured trees and vines. So this is the one where it really makes a deviation from how trees and vines are indemnified. There's a completely different calculation. The calculation for insured trees and vines, it's going to be the same calculation if they were uninsured, same thing that we're doing in Puerto Rico for the insured. But you can see, same idea of what is calculated here. In this case, I would expect very limited questions from the insured to you all, because largely this all falls within FSA. But you can see where it's pre-filled. So it's really, if there's any of the questions on the pre-filled parts, they may be coming to you all for any questions there. But they're going to turn in the number of trees destroyed and the number of trees damaged. From that, we can do a calculation. And you can see down here at the bottom, but there's an expected value, and then we have an actual value. So it's the same premise there. But really, when we're talking about trees, vines, adding in bushes, it's the how we calculated trees, bushes, and vines when we go back to when we first had that 2017 WIP and WIP plus. Same idea, you have 3 growth stages. There are damage factors. Producers are going to turn in records to support damaged trees and the number of trees destroyed. So it is a deviation from how the trees, bushes, and vine are indemnified. The other difference here is because of the way the calculation works, we are not taking into account any potential indemnity, because if you look at the way the calculation, you kind of piece through it, it pays on each tree. So there's no loss threshold that has to occur first on the tree, bush, and vine calculation. So we're not needing to take into account that difference between the coverage level and the SDRP factor as we do with those other calculations. So in this one, it's just that straight calculation by our expected value, number of trees damaged plus number destroyed plus damaged times a reference price. That gives you our expected value. To come up with my actual value, we're going to have to figure out what is the damage destroyed value. You can see there's kind of a bunch to it. It's really not that complicated, but we're going to take the destroyed times a reference price times the number damaged times that what is their damage factor. So how damaged were they? times that reference price. Then we're going to take that expected value minus that damage destroyed and give us our actual value. So that's how we determine it. You apply an SDRP factor in there, so we get a liability minus an actual value and gives us a calculated loss. So with that, that is the end of the presentation, and we can go through and start answering questions. And Chris, is there anything else that you wanted to address before we take a look at questions with our remaining time?
I don't think so at this time, Chris.
All right.
Okay, so Chris, I'm going to ask you some questions. I'm going to cover a couple just general ones right now. There was a question about on stage 1, we capped it at a 35% payment factor, which stage 2 is the same way. We will not know if that payment factor is going to be increased until after the end of enrollment. We have to see what the universe and the dollars applied for are before we know if we're going to have sufficient funding to increase the factor. So that will be after the end of enrollment, which would be after April 30th of 2026. There has been a couple of comments about contacting your county office and them informing producers that the stage 2 is not available until after the first of the year. If you'll email me, and I put my email in the chat with the state and county, we can make sure that they understand that you can apply in the month of December. Now, of course, all of this is on an appointment schedule basis now. And it's a requirement for county offices to use this appointment scheduler. And so there may not be available appointments in the month of December. They may have already been booked up until January. And that's just because of bandwidth and the number of producers that are interested in the program. So it just depends on the specific situation. Okay, Chris, there's a couple of questions on production. So on the APH yield-based crops that are downloaded, the production data from RMA is pre-filled. I think it's item 23. But is it a requirement for them to enter something in 24 if they agree with 23, number 1?
No, so there's no requirement to put anything into item 23. If the producer looks at item, or I'm sorry, 24, if the producer looks at item 23, which is may be pre-filled, if they look at that and say, yep, that's representative of my loss, then producer can just sign off on it. They do not have to turn in any records to support what's pre-filled. The only time a record has to be turned in is if they put something in item number 24. And the other thing to point out too, it's important that they understand, is that number needs to be share adjusted. And so share adjusted means they need to account for their share of that crop. So share is not part of that calculation, as you maybe saw in some of the other ones. But if my production, I have a 50% of the policy, Kathy has her own 50, but it's 100% of the crop, I'm only going to have to we want to make sure the production you turn in is share adjusted for just my 50% and not accounting for Kathy's.
Thank you for going over that, because that was the next question.
And can I just add real quick on that is the crop insurance share. So the crop insurance share that was on, that acreage report for that year to align then with the SDRP liability that's showing. And then the production, when it is pre-populated, I think most agents are probably familiar with the term same year production reporting. That's the manner in which that's the data that's being used to pre-populate when that has been submitted, from you all through the AIP to RMA.
Okay, and let's see, Chris, will you just sign up at your home county FSA office, or will you have to sign up at every county you're located in?
It is just one application. So it is recording county, I believe is how we refer to it. So it's one application nationwide.
Do the applications follow the MPCI unit structure that the producer chose?
Yes. Yes. So those will be pushed over based on the unit structure, same as stage one. So it's going to follow. We try to mimic stage one as much as possible, and units is one where we are able to do that.
Okay, I see that there are multiple questions about the harvest price and the price that we're going to use. Can you go over that one more time, please?
Yes. So under some of those APH crops, some of those plans have a harvest price. We are not using that because that harvest price could be different, as you're aware, from the price that they had at the time of liability. And so to keep it consistent with how we are calculating, it's just a single price is used in that calculation. So the price that we're using is the price that was used at the time to determine their liability. So at the time of sales closing, that's the price that's being used. We will not use a harvest price, which may come in less than that liability. And that keeps us in line with how the liability was calculated. So it's paying more on a production loss and not the revenue side.
There's a couple of questions on protein and quality. Is protein considered a quality loss component for SDRP?
Is that, I think I need a little bit more information. Is that a forage question on protein, or is
it could be wheat and feed grains?
So yes, and so that is something, that is one of the quality factors they can take a look at. If you're looking at on the forage side, it's going to be based on the respective factor they're using. So RFV, TDN, crude protein could be one of them, but that is something that can be used as, to determine where they fall on there.
Okay, we're at the 11 o'clock hour. There is one question, a general question I do want to answer. Applications will not be mailed to producers. That is correct. We are not mailing applications to producers because it does take more interaction with the county offices, because there are, more components to this stage of the program. So we are not mailing applications to producers. And then as a reminder, this has been recorded. It will be posted on the website. So those agents that were not able to listen during the live event, you can go into the website and listen to the recording. And then there was one other question that's a general question. Are we going to have an additional training on uninsured and NAP covered? And no, this was totally focused on insurance agents and the insured components. So there's a ton of questions that are in here, which we thank you for doing that. It helps us understand the questions that are going on in the field. So we will address these. It will not be today, but because there are a lot, and we will collaborate with RMA to make sure that there are answers provided on each question that will help, all of you and your producers. And then those will be posted on the SDRP website. So Chris, is there anything else that we haven't covered, or RMA, is there anything that you would like to cover before we shut the call down? Okay. All right. Well, thank you for your participation and your attention. And we look forward to working with you on SDRP Stage 2. Have a great day.